One trade goes wrong. Just one. A gold position that reversed at exactly the wrong moment. The loss itself isn't even that big, but something inside the trader shifts the second it happens. His jaw tightens. His breathing changes without him noticing. And a single thought forms, quiet but absolute. I'll win it back. 30 minutes later, he's taken 3 more trades. None of them followed his plan. An hour after that, 5 trades deep, his account isn't just down for the day. It's gone. Not because the market turned against him. Because he turned against himself one impulsive click at a time. Tonight we're talking about the trap that has ended more trading careers than bad strategies, bad brokers, and bad luck combined. It's called revenge trading, and by the end of this, you're going to understand something that most traders never figure out even after losing everything to it. It was never about the money. It was about the pain. Most people think revenge trading is simple. You lose money, so you try to make it back. That explanation feels obvious, and it's almost completely wrong. Revenge trading isn't really an attempt to recover money. It's an attempt to recover something far more personal. Your ego, your sense of control, the version of yourself that felt competent 5 minutes ago and suddenly doesn't anymore. When a trade goes against you, it doesn't just cost you dollars. It triggers embarrassment, even if nobody else saw it happen. It triggers frustration at being wrong. It triggers a desperate need to be right again, immediately, before the discomfort has time to settle. And underneath all of it is a complete loss of self-control disguised as determination. A professional response to a loss looks almost boring from the outside. Accept it, log it, move on. An emotional response looks like urgency, like conviction, like someone who's finally found their moment. That's the cruel part. Revenge trading never feels like losing control. It feels like finally taking control back. Let's go inside the brain because this isn't a character flaw. It's a biological event happening in real time. When a loss hits, especially one that feels unfair or sudden, the amygdala, the brain's threat detector, can effectively hijack the rational mind. This is sometimes called an amygdala hijack, and it means your emotional brain takes over decision-making before your rational brain even gets a vote. At the same moment, your body releases cortisol and adrenaline, the same stress hormones designed to help you survive physical danger, not navigate a financial market. Your heart rate increases. Your thinking narrows. This is the fight or flight response, except in trading. There's no wolf to run from and no enemy to fight, just a red number on a screen. So the body chooses fight, and the fight becomes the very next trade. There's a specific pattern here called loss recovery bias, the deep psychological pull to recover a loss immediately rather than accept it and move forward rationally. This bias exists in almost every human being, not just traders, but in trading it's uniquely dangerous because acting on it costs real money instantly. Layered on top of this is ego protection. Being wrong feels like a threat to your identity, especially if you think of yourself as a good trader, a smart person, someone who's supposed to have this figured out. The fastest way to protect that identity, at least it feels that way, is to immediately prove yourself right on the next trade. This creates what's called an emotional decision loop. One bad decision creates a bad feeling. That bad feeling creates urgency. That urgency creates another bad decision. And the loop repeats, each cycle slightly more reckless than the last, because the emotional brain is now fully in charge and it doesn't know how to stop itself. Poker players have a name for this exact state. They call it tilt. It's the specific moment when emotion becomes stronger than logic, when every decision from that point forward is being made by frustration instead of strategy. Traders experience the exact same thing, even if most of them have never heard the word. Once you're on tilt, you're no longer trading the market. You're trading your own emotional state, using real money to try to fix a feeling that has nothing to do with price action at all. A poker player on tilt starts calling bets he'd never normally call. A trader on tilt starts taking setups he'd never normally take. The cards and the candles are just the surface. Underneath, it's the exact same collapse. Have you ever doubled your position size right after a loss without even fully deciding to? Be honest with yourself. Was it really the money you wanted back? Or was it your pride? Let's look at exactly how one loss becomes 5. It starts with a single loss, ordinary, the kind every trader takes regularly and normally shrugs off. But this time, frustration creeps in immediately instead of fading. That frustration creates an urgent need to recover. Not tomorrow, not after reviewing the trade. Right now, in the next 5 minutes. That urgency leads to a bigger position because a normal-sized trade doesn't feel like it will recover the loss fast enough to satisfy the emotional pressure building underneath. Taking a bigger position requires breaking the rules that would normally prevent it. And once one rule breaks, breaking the next one feels almost natural. That oversized, rule-broken trade produces more losses because it was never built on analysis in the first place, only on emotional urgency. More losses create more emotion demands more action, and within the hour, an account that took months to build has been dismantled in a single uninterrupted emotional spiral. Here's something important to understand. Intelligence does not protect you from this. Doctors experience it. Engineers experience it. Business owners experience it. Even professional traders with years of experience it, because this isn't a knowledge problem, it's a nervous system problem. Under enough stress, everyone's decision-making narrows in exactly the same way, regardless of how smart they are or how many books they've read. The only real difference between someone who recovers and someone who doesn't is whether they've built a system that catches them in that exact moment, before the emotional brain finishes taking over completely. A trader in gold takes a loss on a clean setup that simply didn't work out, nothing unusual about it. But this time, instead of logging it and stepping back, he immediately re-enters with double the size, convinced the market owes him a correction, most. The trade moves against him again, faster this time, and he exits with a loss twice as large as the first one combined. The lesson here is simple. The market doesn't know what you lost 5 minutes ago, and it certainly doesn't owe you anything back. A trader in Bitcoin watches a position get stopped out right before the market reverses in his original direction, the kind of loss that feels almost personally cruel. Instead of accepting it as normal market noise, he reopens the exact same trade without a stop-loss this time, telling himself he just needs to give it more room to prove he was right. The market drops further, and without a stop in place, the loss becomes far larger than any single trade should ever be allowed to become. The lesson is that removing your stop-loss after a loss isn't confidence. It's your ego refusing to admit it might be wrong twice in a row. A trader in Forex takes 3 losing trades within 20 minutes on the same currency pair, each one a slightly more aggressive version of the last. By the third trade, he isn't even looking at his setup criteria anymore. He's just clicking, driven by a growing need to end the day in profit, no matter what it takes. He finally closes his charts an hour later, having lost more in that single session than in the previous entire month combined. The lesson is that once you're several emotional trades deep, The goal quietly shifts from trading well to simply making the pain stop, and those are never the same thing. Have you ever broken your own rules because one loss made you emotional and then justified it to yourself in the moment as a smart decision? If yes, you're not alone. Almost every trader who's been in this business long enough has a story exactly like this one, whether they've shared it publicly or not. Here's how professionals actually respond after a loss, and it's far less dramatic than anything revenge trading produces. They accept the loss immediately as a normal, expected part of doing this job, not as evidence of personal failure. They walk away from the screen physically, even if just for a few minutes, creating distance between the emotional spike and the next decision. They review their journal calmly. Later, when the nervous system has settled back down and rational thought is actually possible again, they protect their capital above everything else, understanding that surviving today matters more than being right today. They reset emotionally before considering another trade, treating their own mental state as a legitimate part of their risk management, not an afterthought. And when needed, they simply trade tomorrow instead, holding on to one quiet, powerful belief that changes everything. There will always be another trade. Let's look briefly at how a few legendary traders understood this exact trap long before anyone had a name for amygdala hijacks or cortisol spikes. Jesse Livermore believed that emotional trades made from anger or desperation were always the most expensive trades a person could ever take, regardless of how they turned out. Mark Douglas taught that the market has no memory of your last loss and no intention of making things right for you, and expecting it to is simply setting yourself up for repeated disappointment. Paul Tudor Jones built his entire philosophy around protecting capital first, understanding that a trader who survives an emotional moment without acting on it keeps every future opportunity intact. Seykota believed that most self-destructive trading behavior comes from unresolved, emotional needs playing out through the market rather than any genuine strategic decision. Ray Dalio approached every painful loss as raw material for reflection, insisting that the discomfort itself, if actually studied instead of avoided, becomes the fastest path toward real improvement. Notice something? Every single one of these traders separated the loss itself from the emotional need to immediately fix it. That separation, small as it sounds, is the entire skill. Be honest with yourself. The last time you took a revenge trade, were you actually trying to correct your analysis? Or were you just trying to feel okay again as fast as possible? So how do professionals practically avoid this day after day without relying purely on willpower in the heat of the moment? A cooling off rule, a mandatory pause of a set amount of time after any loss before another trade can even be considered, removes the ability to act while the emotional brain is still in charge. A daily loss limit decided in advance and treated as completely non-negotiable physically stops the bleeding before it becomes a full spiral. A trading journal that specifically tracks the emotional state after every loss creates awareness of exactly how this pattern shows up personally, because it looks slightly different for everyone. A maximum number of trades allowed per day prevents the kind of unlimited access that lets one bad decision become 5. A walk-away rule, treated as seriously as any technical rule in the trading plan, gives the nervous system time to actually recover instead of staying flooded with stress hormones. Risk management decided before the session begins removes the temptation to increase size in the heat of an emotional moment. And a simple breathing pause before every entry, just a few seconds, creates just enough space between impulse and action for the rational brain to catch up and actually participate in the decision. A checklist before every trade, without exception, forces that rational participation to happen every single time, not just when things are going well. If you were my younger brother sitting across from me right now, here's exactly what I'd tell you about this. You revenge trade because losing feels like more than losing money. It feels like losing a piece of who you thought you were in that moment, and your mind wants that feeling gone immediately. Professionals don't avoid this feeling because they don't have it. They avoid acting on it because they've built rules strong enough to survive the exact moment it shows up. The traders who eventually make it aren't the ones who never feel the urge to get even with the market. They're the ones who've made peace with one simple, uncomfortable truth. Some days end in a loss, and that's allowed. Start today by writing down a hard rule for yourself that after any loss, a fixed amount of time must pass before you're allowed to open another trade. No exceptions, no special circumstances. Track your emotional state honestly in your journal after every loss, not just the outcome of the trade, and you'll start to see your own personal pattern clearly within a matter of weeks. Set your daily loss limit low enough that hitting it genuinely stops you, not so high that it only kicks in after the damage is already done. And the next time you feel that specific heat rising in your chest right after a loss, that urgent need to immediately prove something, stop and ask yourself one simple, honest question. Am I trying to fix my analysis right now, or am I just trying to fix how I feel? Brother, the market never remembers your last trade. The only person carrying that loss into the next trade is you. Somewhere out there tonight, a trader has just taken a loss, and his hand is already moving back toward the mouse, driven by something that has nothing to do with his strategy anymore. And somewhere else, another trader has just taken the exact same kind of loss. And instead of reaching for the mouse, he closes his laptop, makes a coffee, and reminds himself quietly that tomorrow is still coming with a fresh account and a fresh mind. One of them will still be trading a year from now. The other one will be telling people the market took everything from him, when really, one uncontrolled hour took it instead. Here's the truth I want to leave you with tonight. The market never asked you to win your money back today. That pressure came entirely from your own emotions, mistaken for urgency, mistaken for opportunity, mistaken for one last chance that was never actually real. In the next episode, we'll uncover overtrading, the silent addiction that keeps traders clicking long after their edge has completely disappeared, and why the busiest looking trader in the room is very often the one quietly losing the most.